everyone, my name is Karen Chen, Senior Product Specialist of the US Income and Growth team. So looking back at the markets in Q3, the underlying asset classes within income and growth have posted mixed return. When we look at the broad market performance, US equities and US high yield have delivered positive returns, and some of these gains were offset by the negative returns in the US convertible bond market. Risky assets, in particular US equities, started the quarter strong, driven mainly by strong corporate earnings as well as positive economic data. And the Fed has also remained dovish as well, reiterating that inflation will largely be transitory and they are not in any hurry to hike rates. However, much of these gains were given back in September when inflation and interest rates worries started to creep into the market. And some other factors such as the US debt ceilings and China property market sector and power outages have also dampened some of the market sentiment. And in September FOMC meeting, the Fed now sees inflation to stay elevated for a little bit longer, and that Treasury yields have also responded and moved higher due to the upcoming Fed tapering and also higher Fed funds rate projections. High yield market held up relatively well compared to other fixed income asset classes given its higher coupon and low duration. And performance of the income and growth fund was consistent with the broad market and have delivered a small positive return for the quarter. Heading into Q4, the pace of US economic growth could have peaked, but the overall level remains elevated. And on the consumer side, what we see is that spending remains to be quite strong, helped mainly by the high savings rate and healthy household balance sheets. And on the business side, we continue to see business spending increasing and that the labor market is still continue to recover. The Fed will most likely announce its tapering in Q4, but we don't think this will end the equity market rally. After all, a withdrawal of easy monetary policy is a reflection of Fed's optimism to economic growth as well. When we look at the previous 4 hike cycles, the S&P 500 index had actually delivered on average a high single-digit return in the prior 12 months to the first rate hike and continued to rally in the subsequent years. Well, there are signs that some of the supply disruptions are also peaking as well, with some of the COVID restrictions being lifted and the bottlenecks at some of the ports have stopped worsening. The impact on earnings should largely be contained and concentrated in a few sectors that are more exposed to supply chain and semiconductor shortages problem. Pent-up demand should drive revenue growth, and we see pricing power and operating leverage should help offset some of the inflationary pressure going forward. And based on S&P 500 company estimate, Q3 earnings is expected to grow at around 30%, still high by historical standard. And on the back of this equity market strength, convertibles should be able to benefit too. The new issuance in the markets continue to provide the fund with a wide range of total return opportunities. And whereas in the high yield market, default rates are low and the rating trends are improving, we continue to see that the high yield market is on pace to deliver a mid-single digit return for the year of 2021. Sure. First of all, I would like to remind everyone that income and growth has a static allocation, which means that the fund will have 1/3 in US equity, 1/3 US convertibles, and 1/3 US high yield. The fund is also well diversified with over 500 issues in it. Positioning in the fund is a result of a bottom-up process whereby the investment team focuses on identifying companies that exceed expectation and have improved credit matrix. And especially in the current environment, the team put a greater focus on companies with reasonable earnings visibility and unique growth drivers. and especially on sectors that do not face much supply chain issues. And within each of the sleeve, the team also continues to look for good total return opportunities in both the primary and the secondary markets, and continue to rotate out of equity-like convertibles into the more balanced ones. But more importantly, the fund will continue to focus on delivering a good, consistent income and capital growth opportunity by investing in the 3 unique asset classes to provide a good upside protection during up markets and downside protection in the risk-off environment.
Allianz Global Investors.